We are now recording and we're going to hop into today's lesson. For those of you that are listening live, I highly encourage you throughout the stream to make note of questions that you have that might come up. And if you are watching the recording, feel more than welcome to put your questions in the chat that we have for all of you guys. It's been a phenomenal start to the Forexia live sessions. I'm truly grateful to be here with you. And so today, we're going to be talking about cryptocurrency and market psychology. And so some of you may have never traded cryptocurrency in your entire life. And that's okay. One thing that you need to realize is that all of these markets are intertwined. And this is something that we're going to come back to. It's going to be the theme for a lot of what I'm sharing with you as we move on through these next few weeks. But to really just start to paint the picture for all of you so that you know exactly where we're going with this, my goal is to help you not only understand the differences between cryptocurrency and the other markets that you're already familiar trading with, but I also want to help you understand the similarities and how you can take the lessons that I share here in the crypto markets and actually apply it into your Forex trading. And so with that in mind, why cryptocurrency anyways? Why are we going to talk about cryptocurrency today? A big part of that is because this is a new and emerging industry, and a lot of brokers nowadays are starting to offer us the ability to actually margin trade these cryptocurrencies. Most of you that are on here today right now, you likely have the option on your broker to go and find cryptocurrency pairs that you can trade. And so we're seeing a huge transition right now. And there's a lot of benefits that come with trading cryptocurrencies. Some of those we're going to explore a little bit deeper as we move through the lessons, such as the order book and how we can use that to our advantage, not only to identify areas of supply and demand and how to use the order book itself to actually plot out our market structure and everything like that, but we're also going to be able to understand a little bit more about just some of the key things you need to know. And so with crypto, the very first thing that I need you to be aware of, especially if you have never traded this market before, is that there's actually two ways that you can go about it. The first way, obviously, what I mentioned just a moment ago, is where you can actually go on your MetaTrader platform and margin trade it. And some of you may not realize that TradingView, I know that most of us use this as our charting platform. They actually offer you the ability to directly trade on the platform. A few different Forex brokers offer you this ability, but cryptocurrency is now making its way onto TradingView now as well, where we're literally able to trade directly through TradingView just by linking our account. And so that's really, really powerful when we think about just how much cryptocurrency has expanded in the last few years. And when it comes down to it, these markets, it has the same psychology, the same sort of structures, the same candlestick patterns, the same, way that we can approach this market, just like anything else. And so this is why I want to spend some time talking about it. I'm very passionate about cryptocurrency. I've been studying it very, very thoroughly now for the last few years. I know a lot of people, including myself, that have had success with it. And so like I mentioned, my goal is to help you achieve that as well. So cryptocurrency, when you're going to trade it, right, you have the margin trading way, but you can also invest in it and you can physically own it. You can physically purchase it. We're not going to go too deep into that route of going and researching projects and understanding some of the fundamentals behind why something like Bitcoin may be more valuable than another cryptocurrency like XRP or Stellar Lumens or Ethereum. Okay, so we're not going to go too deep into that. We're going to go more into the technical side of things. Next thing that I need you to know, okay, volatility. If you're used to trading Forex, something like, let's come over here and look at GBP USD. So I'm going to clear literally everything off here on the screen. But volatility, it's simply we're gonna refer to it as how much price might move in an average day. Okay, so in something like GU, for those of you that don't really know how to count pips very effectively, or you're not quite certain how to understand how much the market has moved in the average day, there is a helpful little tool here on the left-hand side, this little ruler, where you can literally click and measure. And that number right there on the right-hand side, 135, that's how many pips this market has moved from where I started the measurement to where I have it hovering right now. Of course, with time and with practice, you're going to be able to just look at the open high, the low, and the close of the candles. You're going to be able to do that mental math. And as we go on, I'll kind of share some of the ways that I actually go and how I use mental math and even a calculator to really just effectively and easily convert my pips so that you can plan out your risk management and all of that. But the volatility is what I want to talk about here for a minute, because with Forex, you might be used to looking for 50 pips in a trade, or 100 pips in a trade, or 30 pips in a trade, right? I don't necessarily know the exact way that you are trading right now, but from what I've observed and from what I've seen through our mastermind community and even through the Forex community that we have, a lot of people are focused on looking to catch 30 or 50 or 100 pips. And that's because the nature of these Forex markets on the average day for a lot of these major pairs, you can only expect that the market is going to move a certain amount of pips, right? And I'm talking 100, 150, 200 pips maybe. Cryptocurrency, if we come back to it, it opens up a much different way of being able to catch pips. And the reason why I say that is because on a normal day, okay, even with this small daily candlestick that we've got printing right now, how the pips work on cryptocurrency pairs, and we're looking at Bitcoin right now. For every dollar that the price changes, that's a pip. So if we go from, say where we are right now at $3,340 down to $3,300, that's going to be 40 pips. If we go from where we are right now down to $3,000, it's going to be 340 pips. And so you can see that a lot of these candlesticks, when we look at them, okay, we have, for instance, right here, November 19th. This was over 1,000 pip move in a single day. And I challenge you to go and look through some of the Forex pairs and see if you can find any sort of asset that moves 1,000 pips in a day. Okay, so the psychology of when we're approaching this market, when we consider the volatility and the big difference between how much we could expect these pairs to move on a normal day, we do need to understand that our positions are going to need to be sized appropriately, but also we have to have the right expectations. Now, expectation, whether it's with Forex or stocks or cryptos or commodities, anything that you trade is going to move in its own unique way. We realize this, but a lot of the time as traders, we may not fully appreciate the fact that every single market is going to have different participants. Every single market is going to have different ways that it's going to move between one zone and another. And so cryptocurrency overall, the reason why it is so volatile is because it doesn't actually take a lot of money to move these markets. When you hear about Forex, the foreign exchange market, you hear the typical statistics that there are trillions of dollars in volume moving around every single day, that when you look at some of the major banks and the major institutions in the world right now, and you realize just how much money they control and how much influence they have in the markets, we're talking hundreds of billions in dollars of volume every single day that just a few banks are contributing. And so the foreign exchange market, it's unlikely that we're going to ever just see a currency completely crash in a day or double in value in a day. You know, we have instances like something on USD-TRY where, yes, we can see rapid fluctuations even on a single day. Okay, but this does not compare to the way that cryptocurrency is influenced, because these markets, even if you only have a couple $100, you have the potential to literally be a market maker when it comes to cryptocurrency. And as we continue forward, I'm going to show you why, and I'm going to show you how you could be the one physically creating candlesticks. Okay, so if you've never taken the time to learn about how price actually goes up and down, when you're looking on the minute or the 15-minute or the hourly or any of these different time frames, if you never truly understood what was happening behind the scenes when we're looking at these candlesticks printing, I'm going to be able to show you how retail traders and market makers and professionals alike, with cryptocurrency, we all have the potential to be the ones on the other end of those candles, to be the ones that are creating the price action. And this is extremely powerful because it's going to let you see the market in a different way. And so I know here at Forexia, one of the big things that we strive to do is help you understand the mechanics behind the market. It's all well and good for us to come on here and draw up a couple patterns for you and look at the market in a way where it's easy to understand, but to then go one step further and show you how the mechanics work, to expand your mind and talk about things like market cycles and lunar cycles and all of these different concepts. This is what is going to equip you for long-term success as a trader. Because think about it. When you look at all of the information that is online right now, you could go and you could learn technical analysis anywhere. You're here for the mentorship. You're here for the in-depth look, for the mindset, for the focus and emphasis on your trading development. And then the technicals come with that, because the technicals are just one segment of how we need to approach the market. And when you think back to your entire life, everything that you've lived up until now, you're going to find that you've been conditioned to be a certain way. You've been conditioned to not think for yourself. You've been conditioned to follow instructions. You've been conditioned to believe that, because somebody says that price is going to bounce at a certain area because it's done that in the past, you're conditioned to follow along with that. And so we're going to break that. We're going to break those psychological patterns through what I teach, through what Brandon teaches, and Dylan, and Mark, Amin, Evan. All of us, even though we approach these markets in a bit of a different way, have a similar mindset. Okay, and so this is what you're going to take away from all of this. You're going to be able to move forward with your trading and even beyond that with how you do your day-to-day life in a way where you are taking responsibility for your actions, just like you're taking responsibility for your trading education. Okay, so with this idea of being conditioned to react a certain way, to look at the market in a certain way, to respond a certain way. Let's look at this chart here a little bit further out for a minute. We're going to take a look at the data from 2017, and I'll highlight it just in case you have any difficulties with seeing it. So 2017, we got the start of the year down here in the red box. 2018, we transitioned into a new year right up here around 16,000. And then of course, where we are right now, coming up into 2019. When we look at this chart and we start to break it down piece by piece, there is an entire cycle literally right in front of your eyes, and it can be a little bit difficult to truly understand why the market reacted in the way it did. And I'm very certain that most, if not every single one of you, heard about Bitcoin this time last year when the price, in a matter of weeks, went from $6,000 to over $18,000 a piece. This was something that when we look at this chart and when we start to understand a little bit more about the cycle that went into this, the human emotion that caused the movement of these candlesticks and the creation of what looks like a massive pump and dump, right? And how price January 2017 was down at $1,000. We see it same time next year up at 20,000, and then coming up to where we are today, down at 3K, right? Let's walk through it. When you're looking at a chart, you need to understand the bigger picture. You need to understand what is actually happening on the macro scale. Because if you get stuck watching the minute, watching the 5-minute, watching the 15-minute, and you're looking at the candles like this, how are you going to ever understand the direction of where the market could actually be headed? How are you going to be able to identify structure areas? How are you going to be able to plan out your targets if all that you're looking at is zoomed in data, it's super condensed? Some of you may not even have a laptop and you're doing this all on your phone, and it's even smaller and even more challenging to actually interpret the market information. We need to step back. And when we look at this, let's walk through what happened. 2017, the start of the cycle, right? Because everything before that, just a massive consolidation. At least that's what it seems. And so we have 2017, a new year started. We can see that price in about 6 months' time, right, from January to July, it tripled in price, it tripled in value, and it created a nice area of structure. We actually consolidated in here for a while. And so if we were to mark this up and just kind of drag that out into the future as a significant area that we want to keep our eye on. Okay, and I'll go into a little bit more about why in a few minutes. But if we wanted to keep this as an area, just something that we're going to keep in mind, we could then continue with our big picture overview of what's happening with this market. And we can see then how if we look to 6 months later from July to the end of the year, obviously something happened in here. Right? Something happened in the market and in the psychology of people that For the last several years, the masses weren't buying. Bitcoin was a sleeper project. It was in the stealth mode. People were kind of talking about it, but nobody really cared. You didn't hear about it on the news. You didn't hear it when you were out and about in public. You didn't hear it on the radio. But once this shift happened, not only did it cause a shift on the technical side of the chart, but it caused a shift in people's perception. It changed people's reality. When for the first time ever, we see an emerging market, something new, cryptocurrency, Bitcoin specifically, go from $1,000 to $3 in about a 6-month time, and then in the exact same amount of time, all the way up to 20. We had a 10 times price increase. And the majority of that movement happened in a matter of weeks. And so if we start to now look at this piece of the puzzle, this one piece, from when we were down at this area in September of 2017 to when we came up to the high in December, we're going to find a couple of interesting things. What happens if we take this whole area of consolidation over here, this recent price action, and we extend it left? We can see pretty easily that this market structure lines up on several occasions. So this was a very powerful area. And the reason why I say that is because when the market started to push away from 6,000 and made its way up to these levels, you need to understand that there were people buying in here. There were people buying in here, up here. Right? These wicks could not have been created if there weren't trades happening at these levels. And what we saw afterwards, pretty much for the last 12 months, is a slow and steady sell-off. And what caused this is a combination of uncertainty and fear from the markets. People that, when you look back at what was going on in the news in 2017, this time of year, you had people taking out second mortgages on their homes. You had people taking out massive loans that they had no plan of action on how to pay it back. You had people that, for the first time ever, wanted to move money into the market because look at what just happened. Price of Bitcoin in 3 weeks went from 6,000 to 20K. I need to buy it because I'm going to be rich. This market is going to just keep going up and up and up. It's the same kind of thing that happens when you get a fundamental news event in Forex, and NFP drops and the market spikes 50 or 100 pips in one direction. How many times have you chased that? How many times has the move happened, or the majority of the move, 70, 80, 90% of the movement, has already played out, and then you buy it? That was the reality for a lot of people. And there's a whole other side behind this movement that we're not going to explore today because I do just want to keep it related to technicals and, the psychology, of course. But there is a lot of people to this day that still bought it in here, that still bought it in here, that still bought it in here, and here, and here, and they've been waiting for months. And guess what? Price still keeps going down to this day. On one side, we have people losing. We have people in 20 or 30 or 40 or 50 or even more % of their account in drawdown. Have you ever found yourself in that situation where you over leveraged a trade and maybe you only had 100 or 200 or 500 or $1,000 in your account? And whether it was the same day or the next day, you're looking at a negative $500 trade, half of your account. What happened? Or you wake up and your margin called and you're no longer in your trade and you maybe even owe your broker money. The reality is the same challenges, the same feelings, the emotions, the psychology that you experience when trading Forex is happening in the cryptocurrency markets. And so we can use this to our advantage because with time, with awareness, and with the proper approach to how we manage ourselves and how we manage our trading decisions, it's going to allow us to approach these cryptocurrency markets and catch even more pips than you may be used to experiencing with Forex or any other market. And before we move forward, I feel it's important for me to emphasize that I'm not a financial advisor. I'm never going to tell you, go and buy this or sell that. Because I would rather take my experience and what I've learned, share that with you, help you have a breakthrough so that you can make your own decisions. Because at the end of the day, I'm not responsible for any wins that you have. I don't get a portion of your profits, right? And so I'm also not responsible for your losses. And this is the same thing when it comes to any other educator. We are simply here to help you, to equip you, and to condition you so that you can trade and think for yourself. Because if we think back to where we started before we continue breaking down this chart, and we think back to that idea of how we've been conditioned our entire lives to be a certain way, to respond in a certain way, to spend our money in a certain way. If you don't make a decision to manage yourself, the universe is going to put people in your life that will manage it for you. And what I mean by that is think back to when you were a baby and you really didn't think for yourself. You had your parents taking care of you, telling you what you were going to eat, what you were going to wear, where you were going to be, when you had to be there. And then you get a little bit older and you go to school and now it's different people, but the same situation where you're being told what you're going to learn and when you're going to learn it and when you need to be there. And if you don't do this, the consequence is going to be that. And then you get a little bit older and you graduate. Maybe you go to post-secondary school, a college, a university, whatever it may be. And then you find yourself in the workforce. You've got a job, maybe even 2 jobs. And it's the same thing, the same cycle, where you have somebody telling you where you need to be, when you need to be there, what's appropriate, what isn't, how much your paycheck is going to be for the hours that you put in. And it completely eliminates the power that we have to think for ourselves. And this is why it's so important to consider this when you do come into trading, because I know that there are people on here that are just getting started. And I know that there are people on here that may have even been trading for longer than me. And I've been trading for 5 years. And through this time, I can tell you that in the first 2 years, it was challenging because I didn't have somebody that I could go to ask questions, to show me things, to challenge the way that I was looking at all of this. Because I did what I was told. I took my Fibonacci tool and I started it at the low, right? The swing low of whatever I was looking at. And I brought it up to the high. And, I was told that the 61.8 level was a pretty strong area, right? And so I would buy it. The price would move against me. And then I would buy it again. Oh, I got some profit. And then price would continue going in the opposite direction. And I didn't understand why I wasn't getting results. I didn't understand why the Fibonacci was failing me. I thought maybe I can go into the indicators and maybe I can add an RSI. Right? And maybe I can customize my RSI and change it so that maybe instead of 70 and 30, it can be 80 and 20. And maybe I can try and find some divergence in here that's going to tell me that everything is going to be okay and that price is going to come back up and I'll be in profit again. And when that didn't work, I did what I was told. I looked for more confirmations. I added a moving average, or 2, or 3. And you can imagine that by the time everything was said and done, let me just customize these settings a little bit. I still wasn't getting the confirmation that I need. And I was so stuck in a place where in my early journey of trading, I really did believe that I was going to be a successful trader. But I thought that that meant adding a bunch of stuff on my screen to try and confirm something that really I didn't even understand. I didn't understand that something like an RSI or a moving average, these technical indicators are just showing me information. Nobody ever told me that a Fibonacci was just visually displaying price levels based off of where I decided to draw it from the low to the high. Nobody told me that the 61.8, even though right here, at 8,000, that's where it was for me. If another trader decided to draw theirs like this, that's a $200 price difference from where their 61.8 is. And I literally didn't even really move where I started it. Nobody ever told me these things. And so the challenge then became, how can I learn more about this? How can I take what I've learned already and apply it in a way where it still makes sense, but in a way where also now I can take advantage of it? And so back to moving forward with this chart. You can imagine the amount of technical confirmations that would have been existent at this whole area, this $6,000 area, before we broke it. You can imagine what people were thinking. I'm going to buy it at 6,000 because this is the floor. This is the support. This is as low as it's going. Because we're told that the more times price bounces off of any particular level, the stronger it is, right? You've heard that. But they don't say why. They don't tell you that the reason why price even bounces to begin with is because back in February, there was enough people willing to buy Bitcoin at 6,000. In April, there was still enough people willing to buy Bitcoin at 6,000. And in June, and in July, and in August, September, October, November, and Do you notice how throughout all of this, sure, the technicals are there, right? We can add whatever we want onto here, whatever indicator that we want, whatever trend line that we want, whatever Fibonacci that we want. We could do so many things to mark up this chart that we wouldn't even be able to see the candlesticks anymore if we really wanted to try to find out why price broke below the $6,000 area. But rather than doing that, doesn't it make more sense to consider the past market structure, but also to understand the sentiment behind this market? It came to a point in time where suddenly there was not enough people willing to buy. There was no longer enough people willing to buy Bitcoin at 6,000, at 5,000, at 4,000. And that's why, a big reason why we've seen price continue to trade lower today. But you also have to remember, in trading, for price to go up or down, for a candlestick to be created, for something to happen in the market, we need someone who's going to be buying and we need someone that's going to be selling, right? There needs to be someone on each side of that trade for something to happen. And without that, we're never going to see movement in the market. And so remember how a few moments ago we talked about those people that mortgaged, second mortgaged their home, the people that took out a loan, the people that couldn't afford to buy crypto, that bought crypto and they're in 20 or 30 or 40 or 50% drawdown. They're burned out. Ask yourself right now, if you bought Bitcoin, say at 9,000, say you bought Bitcoin at 9,000 back in May of this year. And for the last 7 months, you've seen your $9,000 investment slowly lose 60% of its value. Do you believe that you would still be holding on to that today? Do you believe that after we got this first wave below 6,000, that you would still even be in that trade? So you can imagine how people that bought in here and in here and in here and in here are feeling. And when we take this and we apply this psychology and this way of thinking over into the foreign exchange market, it's the same thing. We talk about market makers. We talk about the dealer. We talk about the candlestick patterns and the stop hunts and this and that. Why do you think they even do any of that in the first place? It is to cause a reaction, a response, to create an emotion inside of you so that you're confused, you're fearful, you're stuck. And even if you were in the right side of the market, they're going to do everything that they can to make sure that they take you out so that once the price does move, you're not in that trade. Trading is one of those things where you can be a master of technical analysis and you can still lose. Because if you don't understand the human component, the room for error, if you don't take that time to really allow yourself to understand how the mind works, you'll be that trader that has all the confirmations in the world. The stars are aligned in your favor. You've got the candlestick pattern, the trend line rejection, the supply and demand zone marked up. You've got the head and shoulders presenting itself. You've got a news article that's coming out. And you could still be that trader that loses. Because it's that same thing where I kind of alluded to earlier, just about managing yourself. With cryptocurrency, we talked about how the volatility is different, how these candlesticks, even though some of them look small, we're still talking about hundreds of pips. Do you believe this little candle right here, this daily candle that I pointed the arrow to, that is a 150 pip candle. But when you look at it like this, that looks like nothing. It looks like the market didn't even move. But that was 150 pips of price action in that little baby candlestick. And so by seeing how cryptocurrency is becoming more dominant, by seeing that cryptocurrency is something that banks are talking about, that hedge funds are talking about, that institutions and our government, they're looking at crypto, they're looking at blockchain, the technology behind all of this, what really gives it value. And once you understand where the people with the money, with the big money, what markets they are looking at, you're going to start to connect the dots of how something like Forex, even though it's not going to go away necessarily, and even though that we could expect the trillions of dollars each day that move could eventually become billions, right? We could see that number decrease. You also need to look at this in a way where by hopping on these sessions with me where we talk about cryptocurrency and some of these other markets, you're also going to learn a little bit more about how money works. And that's not something that we're going to go too deep into today, but with this market in mind, with the crypto markets and the Forex markets, when we look at them side by side and we understand we're going to see those same technical patterns, we're going to be able to implement the same sort of methods where we can break the market down into cycles. That whole idea of Asian consolidation, London breakout, New York reversal. You're going to find those same kind of things over here in crypto because it's the same people trading these markets. It's the same psychology, the same thought process. And I want to show you guys something really cool here in just a minute. And it's really just going to break down the market cycle at more of a high-level overview for those of you that really haven't been introduced to it. But before I do that, the only other thing that I really want to get into with this is the fact that cryptocurrency, we talked about how this little candlestick right here is 150 pips. The spread on that might be 20 or 30. Have you ever taken a trade on a Forex pair with a 20 pip spread or a 30 pip spread? You can imagine how if you've got a $500 account, you're used to trading standard lots and over leveraging it. There's nothing wrong with that per se. But if that's your trading style and you're used to that with Forex, you may only be faced with a 2 to 3 pip spread, if that. But can you imagine opening up a trade on a $500 account with a standard lot, not knowing that you're about to be $250 in drawdown and the price hasn't even moved yet? Okay, so those are just things that you need to consider if you do choose to trade cryptocurrencies, if you do choose to look at cryptocurrencies, but understand that we can learn a lot from these markets. And a lot of it is based off of psychology, but it also is going to give us the ability to look deeper, like I said, at how these candlesticks are created. One other thing that you need to keep in mind is that you can trade cryptos literally anytime. I know a lot of people in our community don't like the weekend. You don't like Friday afternoon. You don't like Saturday for whatever reason, I don't know. But you don't like it because you can't trade. The market's not moving for us. We can't trade Forex. We can't trade gold. We can't do these things that we're used to doing Monday through Friday. It's not the case with crypto. If you really are a pip addict, you can hop on the crypto charts over the weekend. They're still moving. The Forex ones are too, you just can't see it. That's why we get the gaps. And like I said, we're going to talk a little bit more about that. With cryptocurrency in mind, before I kind of open it up for any questions and before we head into the final part of what I'm going to share today, we'll go right now, and I'm going to give you a preview of what we're going to be getting into next week. And this is looking at, okay, so this is an exchange. This is Coinbase. Some of you may have access to this, some of you may not. We're not going to necessarily be trading through here or anything like that, but we're going to use this because this is the order book. These are the buyers. These are the sellers. These are the real-time orders that are coming into the market that are causing these same candlesticks that we're looking at over here on TradingView to be created. These same candlesticks that we see go up and down over here are a result of what's happening over here. And so we're going to explore next, in the next session with me, how and why we use this, how this can be beneficial for us to not only identify key areas in the market for our structure, right, key zones, but also how we're able to use this to our advantage to understand where other people are looking at, to understand how we can capitalize on that, how we can leverage that. Could you imagine how you would approach the Forex market if you had an opportunity to see what buys and what sells other people were taking? Big money, the people that had millions or billions of dollars that are participating in the market. What if you could literally see the exact prices that they were taking their orders, the exact prices that they had buy and sell limits, the exact way we can do that through cryptocurrency? Okay, so this is going to be what we go over on the next session. I just wanted to kind of open it up to you now so that if between now and then you wanted to go and research it a little bit, or if you've used it before but never really understood it, that's what you can look forward to. And the last thing for today's session that I want to share with you, just to kind of bring everything together about market psychology. We are traders. That means that we can trade anything and everything as long as we allow ourselves to get in tune with those markets, to get in tune with the cycle, to get in tune with how the nature of the market works. Because the more that we learn about the nature of the markets, the easier trading becomes. And so if we were to go and look at something else, right? Another market, the US 30, the Dow Jones Industrial Index. This chart basically measures 30 of the most influential companies in the USA. And it averages it out, their market caps. And we can trade this, right? We can trade this the same way we can trade Forex, the same way we can trade crypto. It's got its own way of moving. It's got its own fundamentals. But guess what? We can still come down onto something like the minute chart. And what I'm about to show you, for some this won't surprise you, but for others, I think that you can already start to see it. But let's walk through the daily cycle. We've got our session break on the left-hand side. This blue line. This marks a new day. That's really all you need to know. Yes, we're on the minute time frame, but what is this? What is all of this? We have our Asian consolidation. That time in the market where if we were to look at the US 30 under a different symbol, the DJI, we're going to see a big gap. right? Because this way of looking at the market through this particular chart, it's not showing you Asian session. It's not showing you any time except for when the New York Stock Exchange is open. So that is why we see that gap. But coming back to the US 30 and looking at the real-time information, we get to see all of that Asian consolidation. And then what happens? London. We get expansion away from consolidation throughout the entire London session, right up until New York Open. We get a little double top. And then we successfully complete the cycle by going from consolidation to a breakout, the expansion, whatever you want to classify this as. New York Open, as soon as New York opened, 9:30 a.m. Eastern, New York stock market opened, stocks were trading. We got the reversal confirmation, that double top, and we got sucked all the way back down, not just to where the Asian consolidation was, but we actually made a new low. We made a new low of the day, going from one trading session over here in red, the next trading session, everything up to this double top, and then we're still in New York session right now. And we've successfully created an entire market cycle right in front of you. This is today. I can't make this up. It's literally right in front of you. A complete from consolidation all the way to everything happening and a new range being created right in front of you. And you may be looking at this and be like, whoa, there's like a head and shoulders in there. Some of you may be looking at this in a different way. Some of you may have never thought to have looked at this on the minute time frame to see the entire market cycle. But that's okay. It doesn't matter what time frame you're looking at. You can still see it. You just have the opportunity to see the market in a little bit of a different way once you do start getting in the habit of looking at higher intraday time frames. Okay, so this is all stuff that we're going to be going deeper into as the weeks move forward. And just keep in mind that no matter what you choose to trade, no matter what time you choose to trade, everybody is going to trade in their own way. And you really do have to manage yourself. You have to set the right expectations. And the most important thing that I could encourage you to do now that you are a member of, this mentorship group, reach out, ask questions, be connected, be involved, leverage us, leverage this. We wouldn't be where we are today without the ability for us to expand on our knowledge, right? And that's why we put this group together. We put this group together to help you succeed with your trading, to give you breakthroughs, to help elevate you, and most importantly, to help you understand the nature of these markets so that you can be winning consistently too. And so we covered quite a few concepts today, from the psychology to volatility and spread, when you can trade, how these markets connect. We went over some mindset and, of course, the idea of conditioning ourselves to take responsibility for our actions and our trading decisions. And in these last few minutes, I do want to, open up the chat. If you have anything specific that you wanted to ask about what I went over, or if you have any comments about what we're going to be going over in the upcoming sessions, now is the time that you can ask. And I'll leave the floor open for a couple of minutes, and then we'll go ahead and we'll look to hop off of here so that we can get the recording all put together and finished. Can Dylan's method apply in crypto trading? Any method can apply in crypto trading. Seriously, any method that you might be aware of already in your trading, whether it's a strategy, whether it's a specific way of looking at the markets, whether it's an indicator, absolutely anything that you can use in Forex can be used in cryptocurrency. So yes, and as the weeks go on and as you learn more from each of us, you're going to understand how it exactly fits on a lot deeper of a way. My specific approach to answer that question, I like to look at this on the intraday. I look at the market every single day. Doesn't mean that I trade every single day. The beautiful thing with how this market is, with us being able to analyze it over the weekend, we get a little bit more data to work with. And so for me, how I look at this market, a lot of it is the psychology. But a big piece of my success is leveraging these order books, leveraging the real-time data, the real-time price action that's coming into the market, because I'm a price action trader. Right? I may take the time to add Fibonacci and to do this and to do that, trend lines and channels, and see what other market participants might be looking at. But I'm looking at the market in a way where I'm looking at the price action. I consider both the retail perspective, and I also consider what I would do if I was the market maker moving the candlesticks. And that's a really fun exercise that you guys could do as well, even with your Forex trading. Right? When you're considering a trade and you're planning out a trade and you're looking to find a good way of managing that, a good way of planning your risk, a good way to enter the market, take a minute and imagine what you might do if you were the market maker. By imagining what kind of pattern you might show or what kind of stop hunt you could expect. By putting yourself in the market maker's perspective after you've already considered what the retail traders are going to be looking at, now you have a balanced way of approaching the market, and you can make an effective decision based off of that. Yeah, it's definitely a process. It's definitely a process. And just know that, like I said, as the weeks go on, we're still just getting started. Right? This is only your guys' fourth session, or fifth session, rather. And so there's still lots that you're going to learn in these next few weeks. And I'm super excited. I'm really looking forward to next week's or the next time that I share with you guys, because today it was laying the foundation. Right? Rather than just going and diving right into things that you've never even seen before, we need to condition your mind, and we need to put you in the right way of looking at this so that once you do have that breakthrough, you really understand it. Okay, so thank you all for being here, whether you were here live on the recording. I appreciate your effort for really taking responsibility of your progress as a trader. I'm looking forward to seeing how we all continue to grow together in these next few weeks. Have a phenomenal rest of your day, whatever time it may be for you right now. And, stay optimistic, because I know that by the end of this month, by the end of this program, you're going to have had so many breakthroughs on so many different levels, and it's going to be so powerful. So thank you all. See you next time. Stay connected, and we will have the recording up for you shortly.